In today's video, we are going to look at a case where an individual is interested in getting a lump sum of money into a whole life insurance policy. The dollar amount he'd like to move into the product is $500,000. We've got a 40-year-old individual interested in moving $500,000 into a whole life insurance policy. He wants to move that $500,000 into a policy over 5 years with 5 payments of $100,000 per year. However, he does want some added flexibility, as he wants to ensure that he can use his money, which is presently right now in cash, just sitting in his bank account. If an opportunity comes around that requires $300,000 or $400,000, he does not want the policy to feel like a burden. Another way to put it is, while we are setting the policy up to handle payments of $100,000 per year for 5 years, in the event that year 2, year 3, at any point in time, if he cannot send the full $100,000 into the life insurance policy to the insurance company, he's not obligated to. And I'll explain exactly how that works when we look at the design of the policy. You'll see that he's committed to approximately $10,000 per year and can add up to $100K per year. So the policy is very flexible in that respect. But what we're going to look at as far as examining the numbers is exactly this: $100K per year for 5 years. We're going to look at what the policy illustrates based on the present dividend interest rate. The company we will look at is one of the major mutual companies, Guardian, which offers a lot of flexibility. Then we'll also look at the guaranteed values, which is a great way to set expectations if you are interested in seeing a worst case scenario. Now we've got this over here, full stop. What this refers to is the fact that after he moves his $500,000 into the policy, he does not want to be obligated to pay anything thereafter. So he's interested in a whole life insurance policy primarily for the cash value benefits. The cash value being a safe, liquid, and tax-free area to position money. Tax-free, assuming we don't trigger a modified endowment contract or another taxable event, but he's interested in the cash value. But here's the big thing. He does not want to be obligated to make payments indefinitely. He wants to be able to make payments at his discretion. He can add money when he wants to, not when the insurance company requires it. And then also he wants to be able to stop after he moves that $500,000 into the policy. So let's take a look. What we'll look at first, actually before I look at the numbers, we've got different products over here. In a case like this, I'll usually show 2 or 3 different options, all the same funding schedules, but I'll show perhaps this L95 policy, a 15-pay policy, and then maybe a 10-pay policy, or perhaps one other option instead of a 15-pay. My point is, if I'm working with someone and we're in the early stages, what I like to see, or what I would like to see if I flipped positions with them, is a couple different options with different companies. Some products that provide more cash value up front, some products that provide more cash value long term, some are more flexible than others. It's important to have awareness. This way I don't find out about a different option after the fact and say, why didn't you show me that? Which is never a good feeling. So in this particular case, we're going to look at an L95 policy, which is a Guardian product. And what that 95 represents is this: premiums are payable up until age 95. So specifically, when we look at this policy, you're going to see a breakdown. We've got $100,000 per year going into the policy for 5 years, which is exactly what he wants. However, his minimum premium, which is the amount the insurance company will bill him for each year, is $10,000. Actually slightly higher than that when we include the term rider, but that is very close to his minimum commitment. And then he has the ability to add the remaining $100,000 at his leisure, which in this case will be another $90,000. Let's take a look. So what we will begin with here is a formal illustration. So when you're working with an agent and you're looking at different life insurance illustrations with different companies that look similar to this, all companies have a different format, and especially when we look at different reports. But looking at this example, it shows exactly what he wants to do. Funding the policy at $100,000 per year for 5 years. We see net premium That's the same as this column, net after-tax outlay. And the column to the right represents cumulative net AT, stands for after-tax outlay. Over 5 years, $500,000 has been paid into the policy, and you'll notice it stays at $500,000 because he does not pay anything else into the policy after that. Now, the $100,000 per year payment is set up as follows. Up here, we've got the premium. What he's actually committed to is the premium plus this. So this OYT represents 1 year term. This is a term insurance rider that is attached to the policy. The purpose of adding term insurance, we'll see the term up here, is it is a cost-effective way to raise the total death benefit, which raises the MEC limit, which in short prevents a taxable event from occurring. Meaning if my policy does not exceed that MEC limit and my policy does not become classified as a modified endowment contract, I can access the cash value without having to deal with taxation on the gains. Now, there are other instances in which a taxable event can occur, and I would check out this video for information on that. But back to this, we've got this policy set up with a minimum death benefit, minimum expenses. His commitment are these two figures combined. Usually, if we're working with someone, we might round up the minimum commitment to $11,000 per year, which is the base premium plus the cost of the term, and everything above the true minimum does go straight into our PUA rider. So it's not as if it's going toward just additional expenses. And then at discretion, all of the remaining PUA funds, I kind of gave it away when I said at discretion, can be added at discretion on an unscheduled basis. Very flexible. You can go into your online portal, mobile app, and just send the funds in anytime you want. And regardless if you hit 100K per year or not, it's up to you. A ton of flexibility there. So in this example, we'll assume that he is going to do exactly this. 100K per year for 5 years. What we've got up here is the present dividend schedule. We see it under non-guaranteed. Net cash value is our money column. Now, if we want to see the guaranteed values, we can see it on an illustration. Let's take a look here. And here we go, exact same policy. But to the left, you see guaranteed. This represents the guaranteed values. 100K per year for 5 years. Break-even point between years 6 and 7, which is very strong. And depending on the company, product, the guaranteed rate, the guaranteed values will differ from product to product. This is very strong here between years 6 and 7. This is a 40-year-old male, regular preferred, so not the top health class, middle of the road. So it could be slightly stronger by year 6, but this is strong. A lot of other products, or if I have a higher PUA rider fee, might break even somewhere between years 8 and 10. And the design has a huge, huge impact on that. But here we have the $100,000 per year option for 5 years. So let's say that this is you. You take this policy out, you send in a check for $100,000 every year, or you send the funds in online, and you stick to this schedule exactly. You fund exactly as illustrated. When year 6 rolls around, what will happen? Will this be automatic? Well, the product that you have, do you remember the name of it? Whole Life 95. What this means is that premium payments are due up until age 95. We'll see that on our online portal. We'll also see it in our formal contract, and we'll even see a reference here in the illustration where it states that a level guaranteed premium is payable to age 95. So does that mean that you must pay the premium up until age 95? Because how we read the contract language and the information on our online portal, it makes it sound like, yes, we have to pay it, otherwise the policy may lapse. And if you're late on a premium payment, you might know this already, you've gotten a notice from the insurance company stating, please pay your premium, otherwise it might lapse. So, will it lapse? In a case like we just looked at, the answer is no. So let's go back down to the illustration. Here's our ledger statement, and we can look at it. If we want to go back to the guarantees, we can do that as well. But here's the big thing. So to the left here, we see the base premium due. First 5 years, we are paying that base premium. We're covering the base premium. then the cost of the term rider, and then everything else goes into PUAs, and our net out of pocket is $100K per year. In year 6, we still have this $10,000 premium due. Our out of pocket is 0, meaning we do not pay the base premium. In order for this to occur, if you send this policy to the insurance company and state, this is what I want to do, this will not automatically happen in year 6. In year 6, the insurance company will still send you a bill. What has to happen, an action step must be taken, because if no action is taken and you do not pay the premium, we'll see this occur, option 2, APL, which stands for automatic premium loan, where the policy will take a loan against itself to pay the premium, which is not always a bad thing. Sometimes people will do this if they have the intention of paying the premium. They just can't pay it on the due date, so they allow the policy to take a loan against itself, cover the premium, and then they pay that loan off later, and the policy functions similar to how it would have functioned as if they had paid the premium when it was due. So it can be a good option, but in this case, pretend it's you, this was your plan. Year 6 comes, and you want 0 out of pocket, and you don't want a loan on the policy. Here's what has to be done. And this is really an action step that needs to be taken on the agent's end, which is this, a premium offset. What this allows for is the policy to pay for itself through the dividends and interest in the policy, being generated in the policy, and we'll see that right here. So here, in year 6, there's our premium of $10,000. Here's our dividend column. So it's $96.65. That's less than $10,000. You don't need me to tell you that. However, a question we get sometimes here is, Steve, how does this work? Because year 5 to 6, my cash value grows by almost $20,000, a little bit less. But when I look at this illustration, I see a premium due, I see a dividend that's less than the premium. So how on earth is the dividend covering the premium when the dividend's less than the premium and my cash value goes up? How does this work? This might help. So Guardian's 2023 dividend interest rate, which is what this illustration is based on, is 5.75%. The guaranteed rate with this product is at 3%, which means the difference between 3 and 5.75% is the surplus, which in this case is 2.75%, meaning the guaranteed piece is not included in that end of year dividend column. It is only the surplus piece. And there's a bit more to it as well with respect to how some of the rider value is used to cover base premium payments as well. When you look at a premium offset, there's more that goes into it. But in short, there's a lot more than just this column that's supporting the premium, which is why our cash value is able to continuously increase. So my point here is in years 6 and 7, this premium offset, if this is what we want to do, we've got to make sure we exercise it, which we request the change with the insurance company. More often than not, the policy owner needs to sign off on paperwork acknowledging, yes, I would like this premium offset to occur, which means I will not be billed, and the policy is going to pay for itself through dividends, rider value, and it's going to perform similar to what I see here. That's step 1. Step 2 is this. Look after year 8. What happens to the premium? It's gone. This is a whole life 95 product. What we did here is step 3. Now, what I mean when I say step 3, going back to this, RPU, which represents reduced paid up. We are eliminating the premium altogether. This is another option that we need to elect. The agent does, and then the policy owner needs to sign off on it. Side note, this is very, very important. Before exercising these changes, what is important is to see options up front. For example, when I'm working with someone and we're considering a premium offset, or we're considering a reduced paid up, whatever the transaction might be, before we actually send paperwork to exercise that, what I like to prepare is an in-force illustration exercising that. This way we can see the exact impact that transaction will have on the policy the year I'm in, next year, and the potential impact moving forward. Why I say potential impact moving forward is every year the illustration may change as dividend rates adjust and such. Illustrations are typically valid year to year, assuming I'm making the full premium and PUA payment up front. But my point is we want to forecast what things will look like or the impact it will have on our policy beforehand, see it, make sure everyone's comfortable with it, and then move forward. If not comfortable with it, look at an alternative. So in year 8 here, we exercise this reduced paid up option, which eliminates the premium, also cuts the term rider. We see a death benefit reduction occur, and our cash value picks up the pace. Let's see exactly how much it picks up the pace by. So here we go. This is the illustration we just looked at. On the left, we've got our dividend values. First year, 100 goes in, cash value, about 87.5. Internal rate of return, negative 12.5%. Where that comes from is the fact that you paid in $100,000. You've got, call it 87.5, which, no matter how we slice it, is a loss of $12,500. However, you do gain a death benefit of over $2 million in this example. The second year, you pay in $100K. The cash value was 87.5. Now it's 189 and change, almost 190, which is an internal rate of return of 1.23%, isolating that year, which comes out to a dollar amount of $2,300, meaning I got my 100K back in year 2, plus another $2,300 in total money received from the insurance company. In yellow is my break-even point. I've paid in $400,000, and I have $400,000. Premium offset years 6 and 7. There's my internal rate of return. And then look at it in year 8. We take a nice little jump when we exercise the reduced paid up option. The reason why is because we've now eliminated that premium. So all dividends, interest, and earnings on the policy can just be kicked back to our policy. It does not need to support a policy premium internally, which is nice. So we see it continue to grow, and there's the internal rate of return. Same thing in dollar amounts. Preparing for a worst case scenario, guaranteed values. So here we've got a guaranteed rate at 3%, internal rate of return, cash value growth in the dollar amount, break-even point between years 6 and 7, very close by year 6. There's our IRR, there's our annual cash value growth. And again, this is on an annual basis, so I can ask the question, what did my money grow by this particular year? I see exactly what it is. Okay, great, move on. Now, why people do this, at least the individuals we work with, the 3 main reasons are often as follows. It's either all of these or sometimes one of these. Number 1, safe money. Regardless of market conditions, my money continues to appreciate. That's always been a huge point of attraction when it comes to whole life insurance products, particularly with the cash value. Number 2, tax-free. If a MEC or another taxable event is not triggered, I can access that cash value tax-free. Again, it's important to be aware of the different taxable events. And then number 3, with respect to the loan feature, we can use the policy like a personal line of credit, meaning I can access direct policy loans from the insurance company, or I can elect to assign my cash value as collateral to a bank or third-party lender and attain a line of credit from them, which has its advantages and disadvantages, like anything. I just want to know the rules of the game and then stay in bounds. I don't want to break any rules and trigger a taxable event or some other type of issue. So let's take a look at a comparison here. So what we've got is as follows. We've got the present dividend values. In the middle is the example we just looked at. This is what he wants, meaning wants to move 100K per year into the policy for 5 years, total of $500,000. In year 6, we want to exercise a premium offset. This is an adjustment the agent needs to do. So your agent wants to do this if you already have a policy. In year 8, we want to exercise the reduced paid up option if the decision is still to eliminate the premium and not make any payments again in the future. Example to the left before I hit on the one to the right. This represents the same policy. First 5 years are identical, but then to the left, we see the premium still due and we see the premium still paid. This will automatically happen, meaning the premium will continue to be billed unless we make adjustments, because this policy is a whole life 95, meaning the premium will be billed up until the age of 95. Unless we make adjustments, what I mean when I say that is the agent making adjustments with the insurance company and you, the policy owner, signing off after you understand them. So in this particular case, he does not want to continue to make payments. We want to exercise what we've got right here. Now on the right, here's something that's important to be aware of, where we've got these different steps. Do not overlook the details. And you don't have to explain all of this to your client, but we definitely need to be aware of it on our own. So what we've got here is, again, the exact same policy. All of these are identical policies. The only differences we have is that changes are being made after starting. So here, we funded it for 5 years and then stopped altogether. We see 0 out of pocket, and if we go to the full illustration, you will see exactly that, because all we did was pull the figures we saw in Excel from the detailed illustration. So here we go. Back to the Excel workbook. What's the difference here? Look at that column in bold black. Base premium is what it reads. What do you notice with option C and option B? What's the difference here? Base premium. In option B, which is what the client wants, $500K, nothing thereafter, maximum cash value performance, we eliminated the premium through that reduced paid up. Here, with option C, we did not eliminate it. So the premium is still due. And that's not always a bad thing depending on your client's circumstances. Here's what I mean when I say that. In this case, once we exercise the reduced paid up, we can't add anything else. I can loan and repay based on what I have available in cash value all day long, but there's no more adding money to the product. With this guy, I still have a premium due, which means if I want to make these payments, resume them, some years pay 10K, some years not pay 10K, I can do that. However, if my intent is truly to pay nothing, and you, the agent, forget to exercise that reduced paid up for your client, or you forget to bring it up, or you forget to have a review meeting, you don't follow up, the relationship is not maintained, and something like this occurs, it continues to be billed every year. Well, what happens to your client? By year 20, comparing the exact same policy, we see a difference of almost $50,000, a little bit less. Where you've paid in a total of $500,000. That's almost a 10% difference relative to what the client has paid in. Now again, that's over 20 years, but still, think of it if it was you. If this was your policy and you wanted maximum value and you found out that a lever was not pulled, a change wasn't made that could have been made, that could have generated greater cash value for you, would you be upset? Most likely. So we want to make sure we are always staying on top of things for our clients to ensure that the product's set up properly and we've got maximum value. Here's another big thing. When we examine the guaranteed values, it becomes even more important. So here we've got the exact same situation, but based on the guaranteed values. We've got the example where he continues to make payments forever, but we've already stated that he does not want to do this. So here's the option where we kill the premium. And in a guaranteed world, this will really work out better or in the best interest of your client. We can see the impact here. The first year, we kill the premium. Cash value is $518 versus over here, it's $515. So we've got a $3,000 difference already. Year 7, they're identical. So when we look at year 20, here, we've got, call it $700,000, whereas over here, you've got $633. So instead of a $50,000 difference, now it's about a $70,000 difference, a little bit less. So we see it amplified a bit more, looking at more of a conservative scenario. Again, the premium is payable up until age 95, whereas this option, because we've exercised the reduced paid up, it's not, because we've eliminated it. What's the long-term difference? It's definitely noticeable. Granted, we're looking at the guaranteed values forever with a company that's always produced greater than the guaranteed values when we look at their performance. If we look at the non-guaranteed values, there's still a difference there. My point is, we want to make sure we don't forget. Monitoring things, maintaining the relationship with the client is very important here. But I hope you enjoyed this. Whether you are interested in a policy, you already have a policy, or if you're in the business and trying to learn more, I hope that this was helpful. If you have any questions, please leave them in the comments below. If you enjoyed the video, please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.